You know, when a major physical event happens in the world, like an earthquake, let's say, most of us just feel the ground shaking.
Right. You just look around and see the immediate chaos.
Exactly. The traffic is stopped, alarms are going off, but, geologists aren't looking out the window.
No, they're glued to their seismographs.
Yeah. They're watching this little needle translate all that terrifying, totally unpredictable physical energy into cold, hard, measurable data.
It tells them exactly how bad the fracture is.
And, more importantly, where the aftershocks are going to hit next. And today, our financial seismographs are prediction markets like Polymarket and Kalshi.
And man, over the weekend, that needle went completely off the charts.
It really did. So welcome to today's deep dive into our source material. We're looking at a fascinating and, frankly, pretty alarming snapshot from today, Monday, May 18th, 2026.
The geopolitical landscape just experienced this massive seismic shift over the last 48 hours.
Right. And our mission today is to explore how these prediction platforms are actively translating all that global anxiety into hard financial probabilities.
Because prediction markets offer a really unique, unfiltered lens into human expectations. I mean, people are putting real capital behind their forecasting models.
It's not just talk.
Exactly. When you have significant liquidity on the line, the noise just filters out.
Yeah.
You aren't looking at sentiment polls or talking heads on TV. You are looking at a brutally honest, mathematically derived assessment of what the crowd actually believes is inevitable.
And whether you're a day trader staring at a terminal or, a commuter just mapping out your week.
Or, honestly, just someone trying to figure out how much it's going to cost to fill up your gas tank tomorrow.
Yeah, these markets are actively pricing in how the mechanics of your daily life are about to change. Okay, let's unpack this.
Well, we really need to look at the catalyst first. The heaviest volume clustering we're seeing today stems from the escalating crisis in the Middle East.
The timeline over the weekend was just incredibly compressed.
It was fast. First, you have a targeted drone strike that triggers a fire near the UAE's Barakah nuclear power facility.
Which is terrifying on its own.
Right. But then, almost immediately following that incident, we see this direct, escalating rhetoric-traded threats between Washington and Tehran.
And the probability shifts on the platforms responding to this sequence are just staggering. If you look at Polymarket, there's this specific, really high-volume contract focused on WTI crude oil for this month.
May 2026.
Yeah, May 2026. As soon as the news of the Barakah incident hit the wires, this contract became a massive liquidity magnet. We are talking about crossing $18.8 million in total bets locked into this single market.
Which is a huge number for a commodities contract like this.
Massive. And the data shows a 63% implied probability that WTI crude surpasses $110 per barrel this month, plus a 42% chance it breaks $115.
Wow.
I look at this and I kind of think about it like a global nervous system. The drone strike is the physical injury to the body. And these oil contracts are the brain's pain receptors just lighting up, signaling that the entire system is about to go into shock.
That's a really good way to visualize it.
But I do want to push back on the rationality of this volume for a second, because are we looking at a market that is just panic buying tail risk because the words nuclear facility and drone strike
Right.
were in the same headline?
Right, like an emotional reaction.
Yeah. Or is this $18.8 million actively modeling a very real structural supply crunch that is basically mathematically locked in at this point?
What's fascinating here is that the market is demonstrating a highly sophisticated understanding of global logistics. It's not a knee-jerk emotional reaction to a headline at all.
Oh, really?
Yeah. The traders driving that 18.8 million in volume, they aren't betting on the fire itself. They're pricing in the geographic choke points.
Okay, what do you mean by that?
Well, they're looking at the UAE's proximity to the Strait of Hormuz. They are actively calculating the specific retaliatory game theory between Washington and Tehran.
Ah, I see.
And they're recognizing that any escalation there physically restricts the passage of vessels.
So they are essentially modeling the maritime insurance premiums and the vessel turnaround delays in real time.
Exactly. They are pricing in the physical friction of getting barrels onto the water. I mean, if maritime insurers pull coverage or they spike premiums for tankers transiting the Persian Gulf, you get an immediate artificial supply bottleneck.
Regardless of how much oil is actually coming out of the ground.
Precisely. That 18.8 million is algorithmic and institutional capital front-running the logistical reality. A huge percentage of the world's daily oil supply is suddenly at risk of being stranded.
Which means the underlying mechanics of global trade just got exponentially more expensive literally overnight.
And that is the contagion effect right there. An energy shock of this magnitude fundamentally alters the baseline input cost for the entire modern economy.
It doesn't just stay confined to commodities.
Not at all. The spike in WTI immediately infects broader financial markets because it reprices the cost of manufacturing, of logistics, corporate margins across the board.
And we're already seeing that contagion play out violently in the equity markets today. I mean, the data on U.S. equities opening direction is just grim.
Oh, it's brutal.
Polymarket's daily contract, tracking whether the S&P 500 opens green or red, showed a near-total collapse in bullish sentiment heading into Monday's session.
Yeah, traders priced in a mere 6% chance of an up open.
A 6% probability. That is essentially the market capitulating before the opening bell even rings.
It really highlights how fast liquidity evaporates when an exogenous shock hits the system. But while Polymarket is capturing this rapid-fire, highly reactive daily sentiment, we're seeing something much more structural happening over on Kalshi.
Right.
Institutional capital is utilizing the platform to build massive defensive positions in macroeconomic interest rate projections.
The interest rate brackets, this is where the long-term anxiety is really showing up.
Exactly. Look at the volume isolated in the number of Fed rate cuts in 2026 contract. It just climbed past $3.7 million.
Wow.
And adjacent to that, there's another $7.3 million sitting in the Fed funds rate after June meeting bracket. The crowd is actively shifting their positioning away from any dovish pivot.
They're locking into predictions of exactly one cut for the entire calendar year.
Right.
So what does this all mean? Because the consensus just a few weeks ago was incredibly dovish. It felt like institutional portfolios were entirely positioned for a glide path of predictable rate cuts.
Yeah, absolutely were.
It's like Wall Street had its bags packed for a summer vacation of easy money and rate cuts.
Yeah.
And suddenly the weather report predicts a blizzard of inflation. It's as if you're navigating a massive cargo ship full steam ahead, expecting a clear port, and suddenly the navigation system updates to show a minefield.
And you're forced to drop anchor in open water.
Exactly. But I have to ask, since Wall Street previously expected central bank loosening, does this sudden shift to exactly zero or exactly one rate cut mean the crowd thinks the Fed is entirely trapped by these rising global energy costs?
Trapped is the precise terminology the market is pricing in here.
Wow.
The crowd understands the Federal Reserve's reaction function to a supply shock inflationary spike. I mean, if WTI sustains at $115, headline inflation mechanically rebounds.
There's no avoiding it.
No avoiding it. The Fed is already navigating a delicate balance, and they just cannot responsibly lower the terminal rate if energy-driven inflation is bleeding into core goods and services.
Makes sense.
So the traders allocating that $7.3 million on Kalshi are actively hedging against the sell-side models that predicted central bank loosening. They are front-running a high-for-longer environment.
Because the geopolitical reality just overwrote the previous domestic economic data.
That is a brilliant way to frame it. The geopolitical reality overwrote the domestic data entirely.
So we have the Barakah spark driving the WTI surge, which then forces S&P sentiment to a 6% opening probability, which in turn causes a $10 million institutional pivot into a high-for-longer rate hedge on Kalshi. The macroeconomic dominoes are just falling in perfect, mathematically modeled sequence.
It's all connected.
Here's where it gets really interesting, though. Because while we have millions of dollars defensively positioning for a macro winter, there is an entirely different ecosystem of liquidity flowing into highly localized micro events.
Yeah, the bifurcation in the capital flow right now is incredible. You have this institutional dread on one side of the ledger, and then highly granular, localized speculation on the other.
Let's look at the NBA playoffs, for instance. Tonight we have the Western Conference semifinals, Game 1.
The San Antonio Spurs against the Oklahoma City Thunder.
Yes. And amidst all this global supply chain panic and Fed rate anxiety, this single basketball game has cleared over $1.86 million in active liquidity on Kalshi's newly optimized sportsbook.
It's wild.
The Thunders are favored, obviously, but we are seeing heavy, concentrated action pouring into Victor Wembanyama's individual prop brackets for points and rebounds.
It highlights a really crucial dynamic, honestly. Capital doesn't just seek returns. It seeks domains of high conviction.
Right.
When the macro environment becomes opaque and basically impossible to model due to exogenous geopolitical threats.
Like drone strikes.
Exactly. Traders rotate their capital into microenvironments where the variables are known and quantifiable.
I want to dig into that psychology, but let's layer in another example first, because it isn't just sports. The data shows significant volume around localized civil infrastructure, too. Specifically, the Long Island Railroad strike.
Oh, the LIRR contract is a perfect example of localized risk management. I mean, this is an event affecting hundreds of thousands of commuters in the New York metropolitan area.
A huge deal locally.
Huge. And the contract is binary. Will the strike resolve before the May 19 deadline? Traders are currently pricing in an optimistic timeline, heavily favoring a resolution.
But the volume is spiking.
It's spiking precisely because we are inside the critical 24-hour window, where the information asymmetry is at its peak.
And we also have to factor in the digital asset space here. The broader public is still heavily engaged, even with Bitcoin consolidating under the $80,000 mark.
Very true.
There is a massive poly-market contract asking, when will Bitcoin hit 150K? That holds $18.4 million in cumulative value.
18.4 million.
Yeah, and the liquidity is split into two major projection pools, June 30, 2026 versus December 31st, 2026.
Interesting split.
So let me challenge the narrative here for a second. With the global system feeling so fragile right now, we're tracking drone strikes, we're modeling maritime choke points, pricing out rate cuts.
Yep.
Why are retail traders pouring tens of millions of dollars into Victor Wembanyama's rebound stats? Or highly speculative, long-duration Bitcoin targets? Is this just pure financial escapism, a deliberate choice to ignore the macro reality?
If we connect this to the bigger picture, it actually reveals a profound psychological mechanism at play in these markets.
Okay, how so?
It isn't mere escapism. It is a search for agency. Think about it. When macroeconomic events, like a nuclear facility fire or a Federal Reserve policy decision, feel entirely detached from your control or your predictive ability, there is an immense psychological draw to environments bounded by clear, inviolable rules.
I see what you mean.
A basketball game operates within 4 quarters and strict parameters. The LIRR strike has a hard contractual deadline on a calendar.
And even a long-duration Bitcoin target relies on the mathematically predictable issuance of a blockchain.
Exactly.
It's basically the difference between trying to model the weather during a hurricane versus trying to solve a complex chess puzzle.
That's a great analogy.
The hurricane is happening to you, right? And the variables are completely chaotic. The chess match, or the Wembanyama prop, is a closed system. You can actually apply analytical rigor and feel a sense of certainty in the outcome.
And this really illustrates the dual utility of the platform architecture. Prediction markets simultaneously serve as a macro hedging instrument for institutional capital trying to insulate against chaos.
And a micro-analytical venue for retail participants exercising agency in closed systems.
Yes, the fact that these platforms can seamlessly handle $18.8 million in WTI tail risk alongside $1.86 million in NBA player props, it proves that they have evolved into a holistic reflection of human attention and capital allocation.
It is honestly a dizzying spectrum to take in. Just mapping out the scope of what we've analyzed from the source documents today. We started with the Barakah spark and the rapid pricing of a Strait of Hormuz bottleneck.
Pushing WTI probabilities toward $115.
Right. And then we followed that contagion as it crushed S&P 500 opening sentiment. And we tracked the institutional pivot as traders completely defied previous Wall Street consensus to lock in zero cuts for the Fed.
A huge shift.
And yet, operating in parallel to that massive structural anxiety, we see millions flowing into localized risk. From commuter rail strikes to individual basketball stats and speculative crypto targets.
It provides a high-fidelity snapshot of collective human priority. The market is constantly weighing the existential against the mundane, assigning a precise dollar value to every potential future.
And there's one incredibly tangible data point that ties all of this abstract financial modeling directly back to the listener.
What's that?
The source data highlights the U.S. average gas prices contracts on Kalshi. We can discuss terminal rates and macro hedging all day long, but those specific consumer-facing contracts are going to show us exactly how fast the logistical friction from this weekend's geopolitical shock will translate to the physical pumps in your neighborhood.
That is where the macro theory literally hits your wallet.
Exactly.
But, as we observe these platforms scaling to hold tens of millions of dollars in liquidity for single events, it introduces a pretty complex dynamic.
Oh, how so?
Well, we've spent our time today analyzing how prediction markets react to external catalysts. They function as a highly efficient mirror, reflecting our collective probabilities back to us. But there is a point of reflexivity we really have to consider. As the financial stakes of these predictions grow large enough, at what point do the markets stop merely predicting the future and begin actively influencing the human behaviors and geopolitical events they're modeled on?
Wait, really?
Yeah. When a prediction carries enough capital weight, the forecast itself can become a powerful force in shaping the actual outcome.
Wow. The observer effect, but weaponized with millions of dollars in liquidity. That is a brilliant and slightly terrifying thought to leave on.
It's definitely something to think about.
Thank you so much for joining us on this deep dive into today's market snapshots. The geopolitical landscape is constantly shifting, but looking beyond the headlines and focusing on the underlying liquidity can help decode the mechanics of what comes next. Keep questioning the probabilities of the world around you, because the ground might be shaking, but if you know how to read the seismograph, you'll always know exactly where you stand. Catch you next time.